So pretty much like the question is from 2020 to 2023, what are my top 5 returning investments? Right? And then I laughed because what people tend to not realize is that investing in startups is a long-term game. You can't expect a return on your investment within 3 years. If you return investment within 3 years, you really got yourself a unicorn. But as investors and as VC, we typically expect to start seeing return on our investments within 7 to 10 years. And that goes right into the next topic, which is, like, how do you make money when you invest in tech companies? But before we get into that, hello and welcome to another episode of the Eunice Ajim Show. I am your host, and just speaking about investing in Africa in general, but very specifically investing in tech startups. One of the biggest misconceptions and what people think don't realize is that investing in tech company takes actually a very long time for you to see a return on your investment. And that typically, I would say 3 ways you get a return on your investment. And I'm just asking because, like I mentioned earlier, somebody said, you've been investing for the last 3 years, like give us your top 5 return capital companies. And I said, well, I don't have any yet that are actually giving me money back, because that's what I believe at the end of the day when I was say, okay, I've actually made money off of an investment is when I get my money back. So the 3 ways before we get into the next phase is like, what are the 3 ways you can make money when you invest in tech startups? I'll say the first one, which is very common across the African tech ecosystem, are secondaries. What are secondaries? It's pretty much, as an investor, let's say you invest at a pre-seed stage. And when your company go out there and they raise a seed round and a series A round, so let's say we got in the deal at pre-seed when they were raising at a $3 million post-money valuation, and you wrote them a $100K check, and they were raising at a $3 million valuation, and then they go out and they raise a seed round at a $10 million valuation, and then they go out and they raise a series A round at a $60 million valuation. And then now they go at a series B, and now they're raising at a $200 million valuation. And you as an investor, you're like, okay, my money went from a $3 million valuation to a $200 million valuation. I think I've had a really good return on my investment. I'm going to cash out right now. So typically what will happen is that you decide to sell your equity to a bigger investor and you get your money out. So let's say with dilution and all of the other things that accounts options, now you only own roughly about 0.5% of the company by the time that the Series B round. You're cashing out, depending of like if there's enough liquid from the investors that are coming into the round, 0.5 or like 0.1 of that $200 million valuation. Now you have a return capital on your investment. The second way, which is probably the most common way, is merger and acquisitions. But we're going to do acquisitions because sometimes with mergers, you don't necessarily get your cash out immediately. So typically an M&A happens when a bigger organization comes and decide that they want to buy you out. And the reason why a lot of companies decide to buy smaller companies, it fluctuates across many reasons. I personally think in the situation from Stripe acquiring Paystack, for example, was really because they wanted to have a footprint in the African market, and it would have been easier for them to acquire a company that had already built the technology that is adaptable to the African market. It was easier for them to acquire a company that already had a good user base than for them to come into the African market and start from scratch. So that's the second, probably the best way, in my opinion. I think in the African market, we will see a lot more M&As happen when it comes around exits than we will see the other 2 that I'm about to mention. And I personally think The third one might be the hardest one, which is IPO. And keep it in mind that I'm speaking very specifically for African tech startups or like tech startups in emerging markets. If you're a US tech startup and you're doing really well, I would definitely say IPO. You have a customer base that they're routing for you, they're cheering for you, go for it. But we all have seen in the last few years, Swivel, Jumia, and so many other emerging startups go an IPO on the US stock exchange, and crazy things happening from that to them, going from billions and billions in US valuations to almost pennies on the stock exchange. And there are many factors why that happened. I have spoken about this in another video in very detail, but to just round it up, typically the first thing I think is because you don't have a US base of customers, so you don't have the cheerleaders that will be out there buying your stock. The whole reason and the whole initiative of going and on the public market is because you have a tribe of investors, of retail investors that will go out there and will buy your equity. And if you don't have that, your equity can easily go from 100 to 0. The next thing is that, in my opinion, because I know some people have different opinions out there, I think a lot of hedge fund traders pretty much bet against your stock. And if you don't have the right resources to be able to like maintain that and like really like fight back, the chances of you going from $1 billion organization to almost nothing is very high. And I have suggested in other videos that instead of going IPO, I highly encourage, especially because so many African countries right now are now doing a lot of efforts to see how a lot of these amazing tech startups can IPO in their local market. Nigeria is one of the very few that decided to make it an initiative and actually add technology as a specific sector on the stock exchange. South Africa is another market. Maybe not put your full company on the local stock exchange, but at least put a little percentage. Test it out, see how it's going, and then maybe even like do a percentage in your local country and another one in the US, but don't put all your bet on the US stock exchange. But typically these are the three ways a startup or an investor will get a return on the investment when they are making investments in tech startups. So to make my answer a little bit short and not as long is I have not returned any capital on the investment that I've made in the last 3 years, but the type of traction, the kind of companies that a lot of my portfolio as of today, none of my companies have died yet, so that's a good sign. The second thing is that a lot of those companies have been able to raise subsequent rounds of funding. For example, I mostly invest in pre-seed, and a lot of those companies have been able to raise seed extensions, and Series A. Nobody yet raises Series B, but because a lot of those things take time. Like I mentioned, on average, it takes 7 to 10 years for you to see a return on your investment. And also just like the growth of those companies. I mean, so many companies that I invested in when they were only doing roughly about $5,000 to $10,000, and so they are doing anything between $150,000 in monthly recurring revenue to over $300,000 in monthly recurring revenue. So amazing companies are happening. Amazing things are happening to these companies across the continent. The market is definitely there. The need is definitely there. And I think it's only a matter of time until the investors and the investment come flocking into the African market. All right, that is it for this episode. I hope you found this useful. And until next time, I just pray that you are living the best version of your African dream. Have a blessed day.